have a limit to our GoToMeeting account. So we offered today's webinar as for those that had registered but couldn't get in yesterday, which we apologize for anyone that got caught up in that mix. The good news is it's because there's a lot of demand for the information. The bad news is we have a limit on the account, so we apologize for those that got caught up in that. But thanks to everyone for attending today. We're going to talk about a lot in the past. We've tried like heck to explain the data and the information, the knowledge that we have from analyzing clubs for the past several years, and we focused very appropriately, I think, but very intently on the numbers and what the numbers tell us, and trying to explain the ratios and whatnot. Today's webinar is a different twist to a degree. We're going to talk more about why this is important and how it really can make a difference in the club boardroom. In fact, I think we hope to touch upon that. The reality is that the boardroom of the private club, which I think anyone in the industry would acknowledge, there is some considerable dysfunction in the vast majority of boardrooms in the country. I would contend that much of that dysfunction arises because boards don't understand the fundamental business of clubs, and that we haven't as an industry come up with a way to properly explain that. And today's webinar is about why the numbers are important and how they can be used to explain both the club industry and the club business to your board, and then of course your own club. As a little backdrop for the kind of the thoughts around how this came to us at Club Benchmarking, I'll just tell a little story. When I first joined my club, the golf club I belonged to, I had been playing golf, but not regularly, and I at the time didn't have a handicap. And so one of my first rounds at my new club, which I was really happy to have, I was on the first tee with a couple of guests and another member, two members, two guests, and it was time to figure out what the bets were going to be and who was getting strokes. So one of the gentlemen said, "Okay, everyone, what's your handicap?" And when it came my turn to recite my handicap, I said, "Well, I just joined the club, and I don't have enough rounds in, and I used to be playing at public courses, and I didn't really have a handy." And one of the guys who was kind of funny stopped me. He said, "Hey, Ray, it's a number, not a story." And we all cracked up and laughed. And I think about that a lot when I think about the way the industry, I think, has operated historically, and some of the things that I do here in my own club boardroom and in other club boardrooms. We at Club Benchmarking obviously are in front of a lot of boards very frequently, and I think that the headline for today's webinar is that to understand the club business, it's a number, not a story. The language of business is finance. It's impossible to understand a business or an industry without understanding the financial ratios and metrics that are critical. And they differ from industry to industry. Most of them are common metrics. The values may differ from industry to industry. But when anyone takes, let's say, a MBA view of an industry, they're clearly going to use finance as a means to explain it. So what we're talking about today is the language of business, finance. We're not talking about accounting. It's not about debits and credits. It's not about the details. It's about the strategic view using numbers. Items like revenue, gross profit, gross margin, fixed expenses, operating bottom lines, capital resources needs, all are key financial and operating ratios and metrics. And the point is, in order to explain a business, we have to use numbers, and frankly, the folks sitting in the boardroom expect numbers. If you ask any business owner if he or she knows their gross margin, or knows their fixed expense to revenue ratio, or knows what their net operating margin is, they could recite it literally in their sleep. Just a quick story in this regard. I happened to be in a meeting with 16 club presidents and 16 general managers at the end of last year. And the night before, there was a networking dinner. I had dinner with one of the presidents. We sat at the same table, very nice man, and he was in the oil services industry. So his company was responsible, it was a fairly large company, by the way. His company was responsible for dropping the materials, the drill bits, the test equipment, the rigs, all the equipment that's necessary at an oil well, such that they could drill the well and log the well and get the oil out of the hole. And when we were having the meeting, I do this pretty much every time I'm in front of board, pick someone that out of the crowd that's working. So I did it with him that day. I said, I know from the dinner, last night that you're in the oil services distribution business. May I ask you what the gross margin of your business is? He said, absolutely. It's 32.7%. He didn't say it's about 35. He didn't say, I'm not sure. He didn't say, I can't remember. He knows it to the decimal point, 32.7. He didn't say, every time you ask that question of any business person, it's the same answer. You never get you never get an estimate, you never get a story. You always get a number to the percentage point. I've had people say 76.1%. I've had people say 23%, 58%, and all those variations in gross margin indicative of the variation in competition in any particular industry. Commodity industries tend to have lower gross margins. Knowledge and highly differentiated product industries tend to have higher gross margins. But the point is, business people understand to the fiber of their bone what gross margin is, what their gross margin is, and how it impacts their profitability. When anyone explains their business, any business owner, they're going to use numbers. If they're explaining it to someone, they want to truly understand it. If someone was going to sell a business, it's not telling them a story. That will be part of the dialogue, but the numbers are critical. Obviously, the valuation of the company is built off the numbers. So the language of business is finance. Finance is about numbers. They're not, one thing I would like to say is, obviously, anyone that knows us, it's not just me, it's our whole team. We're very passionate about the industry. We're very passionate about what we do. We love the hospitality industry, and we're trying like heck to help the dialogue that occurs in clubs and in the club board and committee room. A lot of the folks that we are close to, we know they're experts and professionals in hospitality, in managing people, in making members happy, in managing a hospitality business. Maybe not so familiar with numbers. Maybe some folks even shy away from them. And when you get into the club boardroom or the club finance committee room, more often than not, sitting on the other side of the table, people that are CPAs or private equity people or hedge fund people, people who live every day with numbers. So there's a bit of an imbalance in power in that regard. Our whole purpose is to help balance that equation, to make sure that the professionals who are so adept at what they do and keeping their members happy and running these businesses called private clubs, we want to make them as comfortable with the numbers as they are with managing the club. And it isn't hard. It's actually pretty straightforward. We can do this. We all can learn these ratios, these metrics that are so critical and so fundamental to both the success of the club and explaining the club to the board that changes every 3 or 4 years. Just as an example of how this works, let's take a different industry. I didn't know anything about the really, still probably know very little other than I fly 150,000 miles a year. But I thought, why don't we pick an industry and use the process to explain it. So I just picked the airline industry. And I didn't go through it all. I think there's about 70 public airline companies in my little bit of research that I did in preparation for this. I just took 3 of them, American Airlines, United, and Southwest. And I went to CNBC's website. You can go to any financial portal, and the same information pops up, and it's extremely common. The income statement that shows up on these financial portal websites shows revenue, cost of revenue, gross profit, gross margin, fixed expense, operating income, net income, which is after the financing costs and interest and whatnot. And every one of these metrics I could pull off the website. And let's just take a look at the three companies and how the numbers tell a story about their different types of the way they operate. So you can see American and United, one has a 32% gross margin, one has a 28% gross margin. The cost of goods in the airline industry basically are all the jet fuel, all of the crew expenses that help, the flying the plane from point A to point B, and the costs of the aircraft, if they purchase the aircraft, and not many companies do these days, they mostly lease them. But if they purchase them, it's depreciation. If they lease them, it's the lease payments. So what you see is that 32 and 28%, and at Southwest, it's very different. They have a very different business model, which became obvious doing this work. 70%, that's incredible. I had to actually dig into it to understand what that's all about, which we'll talk about in a minute. But what it is after the cost of getting people from point A to point B, there's the gross profit left, and it's the pile of money that the company has to cover the fixed expenses, which are basically all the G&A, the CEO, the finance people, all of the pilots that do the training, and all of their advertising and marketing. And then that leaves you with your operating income, your operating bottom line. If you look at the operating income and the operating margin, which is the income divided by the revenue, you see 18%, 14%, 21%, extremely common, pretty close. Very typical to see very common operating margins in a given industry. Again, knowledge industries would be in the 20% range. Commodity industries would be closer to the 10 or 15% range. The airline industry is pretty close to a commodity industry, except for Southwest. Interestingly, they have a much higher gross margin, and they have a much higher gross margin for very key reasons. Their planes, because they turn them around quicker and they fly into smaller airports, are in the air for 9 hours a day on average versus 7 for traditional carriers. So that's like they have to buy 20% less planes as a result of that fact. That's a very significant contributor to the higher gross margin. The pilots are paid less, although they're fighting for more now. They're better at hedging fuel prices, so the ups and downs of jet fuel don't hit them as hard as the other companies. And this is a key piece of it. They only maintain one type of aircraft. Southwest only flies 737s. All the other companies are flying Airbus, Boeing, every type of plane you could imagine. So that means they have less maintenance people. They have less spare parts. It's just simpler. It's a more rational business. Now, interestingly, because they have a higher gross margin, look at their fixed expense ratio. They have more money to cover fixed expenses. And so what they do with that excess money is they actually advertise more. This is kind of an interesting exercise. I love watching sports and news on TV, and think of all the Southwest airline ads you see. Constant. You don't see as many for American and United. You do see them occasionally, but not nearly as much. If you look at the top 10 travel companies, the spend they make on TV, none of the airline carriers but Southwest are in the top 10. And guess where Southwest is? They're number one. They spend more than any other travel company on advertising. And what they've done is they've created a brand. We all know Southwest's brand. It's the fun airline. It's the low-cost airline, et cetera, et cetera. They've actually created a brand in the mind of the consumer, whereas American, United, Delta, they're more commodities. So as a result, while their operating margin on a percentage basis looks pretty similar, it's actually 50% higher than United. It's 17% higher than American. And then when you finally get down to return on equity, which is the ultimate metric, which everyone in the club board and the finance committee room all know what return on equity means and how the impact it has. It shows basically how efficient and profitable, how efficient at capital use and how profitable a company is. And you can see that the American and United numbers look a little wacky, and that's because they both had bankruptcy in the last several years, which goofs up the equity line. By the way, that's pretty similar in clubs. In any case, What we just did is we learned a little bit about the airline industry, and we learned it by using numbers, and the numbers tell us about the competitive strategies and differentiation in the companies that compete. It's no different in the club industry. It's the exact same thing. That model that I use to describe the airline industry is it's a very simple financial model. It's used in every industry. Wall Street uses financial models constantly. They are used to predict success and failure in companies. Financial models, all they do is illuminate or draw out the relationship between profit and revenue, margins, leverage, expenses, etc. So it's a financial model that very simple and very simply explains both a company, and the industry in which it competes. On Wall Street, people get paid a lot of money to develop models because it works. That is the way that companies predict which companies will be future success or future losers. And these models reflect the key drivers. So gross margin is a critical driver in any industry. Operating margin, return on equity. These are all very common metrics, and they're all very important metrics. While many of the clubs in the club industry are not-for-profit member-owned clubs, that doesn't mean that we aren't businesses and we aren't financial entities. We are. Clubs are businesses, and as such, they have key financial and operating drivers as well. Just to use another analogy, which I think is important, one of the things that we sometimes run into when you get in front of a board, my contention is that there's two people on every board that I'll consider, let's just say they're the strong-willed, extroverted folks that probably know the answer to the question before the question's asked, if that characterizes some. One of the retorts that I've heard is, I don't care what other clubs are doing. What the data that we have discovered and the models that we put forth, they're not about trying to compete with the Joneses, so to speak, or keep up with the Joneses. It's not about what other clubs are doing. It's about learning. It's about understanding the industry. Imagine if you took cholesterol as an example. Suppose that you knew your cholesterol level, but you didn't know what the scale was. There was no way to isolate how your reading related to what the fundamental issue is. The issue with cholesterol isn't the number that you have. The issue is how does it relate to coronary artery disease, which is deadly. So this graph, which I picked off the internet, it shows cholesterol levels, and it relates to autopsies that were done over a period of time, a study, on 136,000 people. And what they did is they related coronary artery disease to cholesterol readings. So the key is that the variation across that 136,000 person sample and how that variation related back to the number, it's the variation that's important, and it's the link to coronary artery disease. So the number explains coronary artery disease ultimately. And without that variation, without the study of a population or a sample population, the number would be meaningless. Would you ever want to go to a doctor whose knowledge is based on the study of a single patient? Can you imagine going to a doctor who's only ever seen you as a patient? What would that doctor know? That doctor would know very little, if anything. I want to go to a doctor that's seen 10,000 people and seen it all. They're probably going to be much better at diagnosing and understanding what the heck's going on with any one patient. That's the whole point of financial modeling. That's the whole point of studying an industry as well as a particular company in the industry. You can't understand a particular company if you don't understand the industry. And so to answer the retort proactively from that board member that says, I don't care what other clubs are doing, the answer is emphatically, you should, because if you don't understand other clubs, you don't understand your own club. There's no way you could understand the industry by studying only one club. The insight is derived from the study of variation. And one of the biggest issues in the club boardroom is this lack of context. Those folks that want to shut the blinds and shut the windows and make sure that we're only talking about our club, those are the ones that are dangerous because they don't understand what the heck's going on in the industry. You don't know where you are in relative terms. It's critical. So the whole purpose of this webinar, the whole purpose of what we do is ultimately about explaining the business. And so I asked this question: can a board be effective without understanding the business? The answer to me is obvious. The answer is emphatically no. A board cannot be effective unless they understand the underlying business. So I'd ask, how do our boards understand the business? Now, in the club boardroom, we believe there are certain pain points, and we think that the management team in the club tends to have difficulty with these particular pain points. We're going to take an example of a few today and talk about them, but through our analysis, we believe there's 16 key performance indicators, and let's just say each of those links to a particular pain point. How much capital do we have? How much do we make or lose in F&B? How about the number of people and the amount we pay them, the payroll at the club? How about the dues and the number of members? Those are examples. So each of these are pain points or key strategic issues, if you will. What we're trying to do with our subscriber base and the industry at large is to explain each of these metrics in a coherent manner. We know they're important. The data shows they're important. That's not up for discussion. That's not the question. Our issue is how do we explain them in a very simple manner, and we are so confident, everyone. You could have flunked accounting in college. You could hate accounting. But we believe everyone in this industry can understand each of these metrics. Just take them one at a time, and if we say over the course of a year, everyone in this webinar, for instance, could become expert at each of the 16 metrics, I would contend at the end of the year, you would be an authoritative expert on the club industry, your club, and you would have, without question, the ability to explain the business in your own club to every new board member that comes in every year, or every new committee member that comes in every year. It is fundamental. It could change the outcome of the industry. Just as if you went to your doctor and you took your physical exam and you got your blood reading, which we do every year, and your doctor came back into the exam room and said, hey, Cronin, cholesterol's bad. That doesn't mean anything to you. But if he came back in and said, hey, Cronin, your cholesterol's 220, and I'm very concerned that you could have a heart attack or a stroke because the blood's not pumping through your arteries because you're going to have coronary artery disease if you don't get your darn cholesterol lower and get some of that clogged arteries, unclog some of those arteries. That's an explanation. That's something I could deal with. Similarly, and we've heard this at Club Benchmarking since we started, there's an old saying in the industry, and I've heard managers mention this to boards, or I've heard board members say it. Clubs are in the dues business. Okay, that's a great statement, but it isn't an explanation. It's not going to satiate the desire of a board member who's intense, who wants to understand the business. Saying clubs are in the dues business is like saying cholesterol is bad. It means nothing. It's a generic statement. It's a story. It's not a story that is of great meaning. Now, if you looked at the dues ratio of clubs like this, here's a particular club, real-world example. The club didn't want to raise dues, hadn't raised dues in 5 years, wanted to make up for it by getting more and more banquet revenue, and over a period of time had driven their dues to revenue ratio to 37%, which you can see on the left side of this chart, which puts them in the second percentile. So 98 out of 100 clubs have a dues ratio higher than this club. What we've seen with the data is that clubs that have a dues ratio of 44% or under, 60% of those clubs have an operating deficit year in and year out. Whereas clubs that have a dues ratio of 57% or higher, the clubs on the right side of the graph, only 25% of those clubs have an operating deficit annually. So we know from the data that the dues ratio is a critical predictor of the operating bottom line in a club. And look at the median operating bottom line. As the dues ratio gets higher, the operating surplus grows exponentially. So the median for operating surplus for clubs with a greater than 57% dues ratio is $150,000. Now, that's an explanation. That's not the platitude of clubs are in the dues business. That's an actual explanation of a metric that can explain success or failure in the club, the dues ratio, and how its variation relates to health or lack thereof in a club, which is manifested by the operating bottom line. Another example, using the dues ratio. We know from our study that there is a difference. We all know in the industry that there's a difference between clubs with golf and clubs without golf. But someone might say, hey, I can't compare. I'm a club without golf. I'm a city club. Why would I ever want to care what goes on in a country club? Well, it turns out that probably the easiest way to actually and accurately explain the difference between clubs with golf and clubs without golf is their dues ratio is different. While the median in the industry of clubs with golf, the segment, is 50%, in clubs without golf, it's about 39 or 40%. So the dues ratio in clubs without golf is about 10 percentage points less than the dues ratio in clubs with golf. The single most expensive expensive fixed expense line item in a club with golf is maintaining the golf course or courses. It's 30% of the overall fixed expense of a club. The reason clubs without golf can get by with a lower dues ratio is they don't have that single large fixed expense. And that's, fundamentally, that's the difference between the two segments in the market. Just another way of using data to explain something that maybe someone would say, I can't explain otherwise. Another example. So we're looking at 3 of these metrics quickly today to kind of lay the backdrop of how we can all learn these metrics, we can all embrace them, and we can use the data to explain the business to the club. How about this one? To the board. How about this one? The statement we've heard 100 times. Food and beverage is an amenity. It is an amenity. That's a true statement, but that isn't an explanation of food and beverage. But if we were to look at the subsidy or surplus in F&B as a department, we would compare it in essence to the total fixed expense of the club. Again, in a club with golf, the highest fixed expense line item is course maintenance at 30% of the overall fixed expense. What we can see is the average club in the industry subsidizes the F&B department to the tune of 4% of the overall fixed expense of the club. So in relation to course maintenance alone, that's 30%. The subsidy to F&B is 4%. That's a very marginal, inconsequential financial impact. It has almost nothing to do with the financial outcome of the club. As a matter of fact, if you go to minus 10, if we were to say 10% is the line between substantial and insubstantial, if you go to minus 10% all the way over to plus 10%, that's 80% of the clubs in the country. So for 80% of the clubs in the country, the food and beverage bottom line represents less than 10 cents on the fixed expense dollar of the club. It's not material. It's insubstantial. If boards understood this, they'd stop asking, why don't we make money in F&B? The reason they ask that question, the reason that's one of the most talked about topics in the boardroom is because board members are making an assumption. The assumption is incorrect. The assumption is that food and beverage has a fundamental impact on the financial outcome of the club. It does not. This data shows that. And board members must understand that so they stop talking about what doesn't matter. An interesting sideline to that is, in further explanation around the food and beverage as an amenity statement, if you look at Group A, the clubs that are on the left, those are the clubs that choose, critical word, choose to subsidize F&B the most. In Group C is the quarter of the industry, the upper quartile. It's the quarter of the industry, 25% of the clubs that make money in F&B. And when you look at the initiation fee in the clubs that subsidize F&B the most, it's $52,500. That's at the median. If you look at the median initiation fee in the quarter of the industry that makes a profit in F&B, the initiation fee at the median is $14,500. It's 300% higher in clubs that choose to subsidize F&B the most. So when I'm in front of some of these boards that I visit, someone says we need to make more money in F&B. I actually ask, you sure about that? Maybe you need to lose more in F&B. Maybe you need to think of it as more of an amenity. And the obvious point of this is that clubs that have, let's say, broader and better amenities and services are the clubs that have higher demand for membership. Higher demand for membership manifests itself as a higher initiation fee, supply and demand. And lower initiation fees are indicative of less demand for membership. So we like to talk about the Group C clubs being cost-centric clubs and the Group A clubs being amenity-centric clubs. Okay, now that's an explanation of food and beverage that a board member can understand. We can grab that explanation. We can use it to explain the business to the board member. And it's a whole different way of doing it than saying food and beverage is an amenity. Another example. I'm sure we've all heard this at some point or another. Every time I ask, when I'm in a club, I ask this question. Have you ever heard someone say, we have too many people or we pay them too much? What's the retort to that? How would we explain that back to a board or finance committee? We can't just say, although we do. We don't have too many people. That's not an explanation. But an explanation might be, here's a club, another real example. I was at the club. The couple of people on the board had convinced pretty much everyone that the staff was inefficient, they paid people too much, and they had too many people. I end up at the club to do a presentation. Turns out this club has a payroll to revenue ratio, total payroll, to total operating revenue of 49%. They're in the 12th percentile. Not only are they not inefficient, they have a payroll to revenue ratio that's lower than 88 out of 100 clubs. There is no way that those couple of board members could ever have been convinced using words. The only way they could be convinced is to see the data. When they see this data, they really, there's nothing to say. I mean, what is there to say? Now, their assumption that the payroll is an issue is a correct assumption. As you can see here, clubs that have a payroll ratio, this is, by the way, clubs with golf, to be clear. Clubs that have a payroll ratio of 53% or under tend to have significant operating surpluses. The median is $230,000 surplus, whereas clubs that have a ratio of 58% or over, they have an operating deficit that's significant, the median operating deficit being $170,000. So there's no question that the payroll issue is a real valid financial concern. But 2 points. Unless we know this ratio, and we know it the way that oil services business owner knew his gross margin to the percentage point, unless we live and breathe and embrace the ratio that distinctly, we can't know where we are. And then 2, when you look at the variation, the 25th percentile is 53, the 75th is 58. That's only a 5 percentage point swing. It's less than 10%, but it has a massive impact on the bottom line. So just as the NFL is competitive, people that watch film in the film room tend to do better than people that don't watch film, because everything, every industry, every business, winning or losing is on the margin. There's not a big difference between winning and losing. And we have to know our payroll ratio to the percentage point, because percentage points matter. So that's an example, 3 quick examples of how we can explain the business to our boards confidently and frankly authoritatively by using data. We can't do it by using words. So in summary of this section, we know the language of business is finance. We know that everyone in this webinar, everyone in this industry can understand finance. It's not complicated, it's simple. It's not accounting, it's not math. It's just using certain key ratios and metrics to explain the business. And I don't believe that a board can effectively govern without understanding the business. Now, in our model, in our financial insight model, we have a common framework. All of the data in the database is apples to apples. We get it into the database via trial balance mapping, so we know we're doing it consistently, accurately, and when it ends up in there, it's all apples to apples. We have an operating ledger, we have a capital ledger. We keep them separate. We get an operating bottom, or a bottom line result for each ledger every year. And this is essentially this slide that we have in front of us. This is it. This is the whole landscape of the financial insight model, and there's certain relationships between all these numbers, and they tend to be ratios, percentages, that are used to explain the business. The whole business of a private club can be explained off of this. No, I'm talking about the financial aspect of it. We know that member satisfaction is critical, and that's a different topic. I'm talking about the financial outcome. What we just saw, that's the lay of the land. What we've done through our analysis, as I said earlier in the webinar, is we've phrased each of these pain points in a question, and if we could help educate the ideal board member, a board member that adds real value to their club, to their fellow members, what we would have is a board member that would come into the boardroom not telling everyone what the answer is, but asking questions. It would be a person that's in the mode of discovery. One of my favorite sayings is, nature abhors a vacuum. And what happens in club boardrooms, I believe, is in the absence of someone authoritatively and quantitatively explaining the business to board members, if someone doesn't take that and do that proactively, there's a vacuum. And you know who's going to fill the vacuum? The board members will fill it themselves. They'll tell the staff what is important as opposed to asking what is important or learning what is important. That's why we talk about food and beverage so much in the boardroom. Everyone assumes it's important, but it isn't. The data shows it very clearly. And if someone can't explain that right out of the gate when they sign up for the board, then they'll explain it back. And that's when things go off track, in my opinion. If they're telling you what matters, then things aren't in good shape. So what we've done is we've collected through analysis, these are 16 metrics that we know tied to financial success or lack thereof. They're very straightforward. They're all framed, each of them is a pain point. Each of them is framed from the perspective of an ideal board member, meaning if someone were to ask a question rather than making a statement, what would the question be? And then what's the KPI? I'm not going to read every line item. We'll send this to, it's going to be available, but we'll send the list to anyone that wants them. These are our annual metrics. They assemble, or in total, they define the numbers that matter in a private club. And I would suggest strongly every staff member on this call or this webinar should know what their ratio is. Whether you subscribe to our service or not, you should know what each of these numbers are in your club. And if you do, you will be confident. You will be able to explain the business to your board member, and you will fill the vacuum rather than having someone else fill it for you. Just as one thing that we've noticed over the years is that we think we've had some success in the industry, but it's funny, you know, we'll go do presentations or education sessions at a chapter meeting and walk away. And sometimes I walk away thinking everyone seems to be really interested, very engaging, a lot of discussion. But when we walk away, I tend to think that, you know what, I think there's some thought that was interesting and that was nice, but what's it matter to me? Well, it does matter. This stuff is mission critical. You can't be a good business person without using finance and understanding your own business numbers. It's not accounting again, it's finance. An example of how mission critical it is the F&B trap. Anyone that is in a boardroom where someone's asking why don't we make money in F&B or why don't we make more money in F&B, that's a proof point that the industry needs more financial acumen, more factual insight, because F&B isn't the financial driver. It doesn't really have much to do with anything financially in clubs. We have to put this issue to bed. I was at a big gated community club in Georgia Tuesday, and it was an all committee meeting and orientation. There was 110 people in the room, and I got a pretty good chuckle out of this. I said, how many times have you been at the 19th hole and one of your fellow members sidled up to you and said, why don't we make food and beverage in this place? Basically every hand went up. I said, how many of you been in the boardroom, in the 19th hole when one of your fellow members sidled up with their martini and said, "We have too many people here and we pay them too much"? Every hand went up. I said, "How about this one? How many times have you been at the 19th hole when someone sidled up next to you and said, 'Hey, what are our capital needs and what are our capital resources over the next 5 years?'" Not one hand went up. Ironically, when you look at the data, the first two are pennies. The third one is millions of dollars. Another proof point that we need to educate. One day down the road, when people come into the 19th hole and they know, all members included, they understand that we have certain defined and quantitatively defined capital needs, and we know what the resources are that we need to meet them, and we know how we're going to generate those resources. That's when the club industry becomes healthier. 50% of the clubs in the country aren't generating the necessary capital over time, and most of them don't even know it. This is just an example of a ratio. We call it the net available capital ratio, that shows where clubs fall. So we believe that a club, to maintain itself consistently and holistically over time, needs to generate between 12 and 15% of its operating revenue in net available capital. Net available capital is the amount of money at the end of the year that a club can do three things with: make capital investments, pay down debt, or put money in the bank. That must be 12 to 15% of your operating revenue year in and year out. Look at this. Half the clubs in the country don't even get to the threshold. The quarter of clubs on the right, that quarter of the industry, they're what we term as capital rich. The quarter on the left, the capital starved. They're literally consuming themselves. That's an important metric. Interestingly, one of the most universal measures of business, and I mentioned it in the airline analogy, is what's called return on equity, which is the ultimate bottom line profitability of an entity or a company divided by the amount of money that's invested in the company that year. Clubs that are capital starved have a return on equity last year of 5%. Clubs that are capital rich had a return on equity of 13%. That's almost 250% higher. That's a fundamental, critical fact. Any business person in any boardroom or finance committee room knows exactly what return on equity is. To my knowledge, it's the first time that I've ever heard anyone discuss it in the club industry. I can't give you the story for the sake of time of how we came upon this at Club Benchmarking. Suffice it to say, this is mission critical. This is critical. These clubs on the left, these capital-starved clubs, are the clubs that are really on death's door. And ironically, it doesn't cost any more to belong to a capital-rich club than it does to belong to a capital-starved club. As you can see here, the dues, the operating dues, are nearly identical in both sets of clubs. One of the things that's different, though, is how many members there are. There's 50% more members in capital-rich clubs than there are in capital-starved clubs. So where's this going? Kind of summarizing all of this, back to my little story at the beginning. It's a number, not a story. We can't use platitudes like food and beverages and amenity, or clubs are in the dues business. That does nothing to explain to an inquisitive board member, someone that wants to hear numbers, wants to hear finance. Those statements will not resonate. The club industry is going to consolidate. It's happening now. There's companies buying clubs, managing clubs. It's going to consolidate. It's going to consolidate from two angles. One is through purchase or management, but the other one is these metrics, which we know are important. They're going to become more omnipresent. They're going to become more a part of the fabric of the dialogue in the boardroom. They are explanatory. They are powerful. They are mission critical. This stuff, the club benchmarking team, we run around, we're doing all the education we can. We're not geeks. We're not out there having fun. It's not complicated either, which I think sometimes maybe folks think it is. This isn't theoretical. This is real stuff. This is the business of the club industry. We've worked our tails off to discover it. We didn't create it. We discovered it through hard work, but it is the natural state of the industry. So in the end, I know there's work now, and I completely support it, where there's more of a standardization, a more common approach to process rationalization in the boardroom. Board policy manuals, orientation sessions, education on best practices, all of that's critically important, without question. However, You could have the best board policy manual in the world. You could have the exact right number of people on the board in the exact terms without contested elections. You could have the best governance structure in the world in a private club. But if those board members don't understand the business, it won't matter, because they won't know what to focus on in terms of the business. And we need to understand the business. It is the underpinning. It is the foundation for success. And we, as people who work in this industry, have to strive to be able to understand the financial data such that we can explain the business to our boards, to our committees, to our members in the manner they expect to hear it, which is using numbers, not stories. We really believe that data and finance based on fact are the future in the industry. So I was aiming for 45 minutes, and I did it in 46. So not bad, but I'm hoping there's some questions. Any feedback, questions, anything? We have a couple of more minutes. Very happy to take questions either now or via email or whatever way you'd feel free or comfortable to do so.
Ray, it's Terry. I do have a couple of questions from the audience. One is, do you have the payroll as a percentage of total revenue by department?
We do have that, yes. We have we know how the payroll, so the ratio of the overall payroll, as we saw it in clubs with golf, is 55% at the median, and we do know in the database how that breaks out amongst the department, yes. The departments, yes, we do.
Another question is, can't a low unrestricted net asset balance result in a distorted ROI if the club has annual capital income that is close to the unrestricted net asset balance? Absolutely.
It's a very insightful question. It warms my heart to hear it because it means that someone's studying in that. One of the things that we've come upon, I was in a room with Terry, by the way, earlier this week with about 20 CPA firms that do accounting for private clubs all across the country. And at Club Benchmarking, we had an epiphany about 3 or 4 months ago. It's such a simple thing, but it's so critical. And it deals with unrestricted net assets. So unrestricted net assets is essentially the net worth of the equity of a club in a member-owned not-for-profit. It's not called shareholders' equity, it's called unrestricted net assets. Return on equity, therefore, we believe is the total, the net available capital divided by that equity number, and the questioner is absolutely right. There are clubs that have a very low unrestricted net asset base. In fact, if we go back and we look at capital-starved clubs, what you see at the median is they have $3.7 million of worth, whereas capital-rich clubs have $13.3 million at the median. That's 4 times as much. So capital-rich clubs, those that generate more capital, have more invested. And by the way, that's the story. They generate more capital because they have more invested, because they're better, quote unquote. Capital-starved clubs generate less capital on a lower base of investment. Now, there are many clubs in this country that over time have actually depleted their unrestricted net assets of their net worth because they aren't reinvesting in the club. So the net worth and the unrestricted net assets has been on a long, steady decline to 0. And in those clubs, just like with United Airlines and American Airlines that have had the same issue because of their bankruptcies, you could have a distorted return on equity number because you could have capital income that's on a low basis of equity in the club. The point, though, is this. Healthy clubs, and every club could do this, everyone on the phone could do this, it'd take about 20 minutes, and it's a huge picture and insight into what's going on at your club. Take your accounting numbers that you get from your CPA, your audited or reviewed numbers, take the last 10 years, go get the unrestricted net asset number at the end of each of the last 10 years and put it on a graph. So start in 2006, go to 2016, and look at the trend of unrestricted net assets over time. There's essentially 3 types of clubs. Those where it's on a steady decline, those where it's kind of going sideways, and those where it's going up continuously. The ones where it's going up continuously, those are clubs that are growing, healthy, and doing well. The ones where it's going down continuously, there is a story at the end of that decline, and the story is probably going to be a closed club. Those that are going sideways, they're doing okay, they're maintaining themselves, but the goal of every business is the goal of every individual is to increase net worth over time, and that's the unrestricted net assets picture. And that was a long question to an answer. I mean, answer to a question, but I think it paints a very important picture.
Okay, I think that's it for questions. Ray's email address is there on the screen if you have anything you want to follow up, or you can reach us at info@clubbenchmarking.com.
So thank you, everyone. We're here to help. We'll answer any questions you have, and thanks for taking the time on a Friday afternoon. Have a great weekend.